Michael Burry's predictions are becoming more and more accurate. Back in early 2021, Burry correctly forecasted the onset of severe inflation and an impending stock market crash. But at the time, his warnings were largely ignored. Since then, the stock market has taken a sharp downturn, with the Nasdaq losing 32% and the S&P 500 falling 23%, all due to unprecedented inflation in the United States. Despite the continued inflationary pressures, the situation remains unresolved as another year passes. Ever since Burry issued his dire warning about market turmoil, the market has experienced an additional 15% decline. Burry, however, isn't backing down, and he recently tweeted, "Nowhere near rock bottom yet," indicating that he believes investors are still not fully grasping the severity of the situation. According to him, worse things are yet to come, and understanding why he is so worried is crucial for those looking to navigate this financial storm. Michael Burry points to three main factors that he believes could lead to an even greater economic collapse than the one experienced in 2008. Due to these three factors, Burry has liquidated most of his stock portfolio. These ominous predictions have sparked much interest and concern, inspiring the creation of this video. If you're someone who finds the intersection of horror and stock market analysis intriguing, then this video is definitely for you. If that sounds like your niche, be sure to like the video and subscribe to our channel for more insights. Burry's predictions are nothing short of shocking. In one of his recent tweets, he discussed how inflation's nature deceives the public by temporarily subsiding, only to worsen when it returns. He pointed out that the government and the Federal Reserve are not the answer to the inflation problem. Drawing from past inflationary cycles, particularly those of the 1940s and 1970s, Burry noted that while inflation may initially subside, the aftermath often leads to a much worse scenario. He argues that inflation isn't just about rising prices, but also about the velocity of money, a critical factor in understanding its long-term impact. Let's break this down further. In economics, the velocity of money refers to the speed at which money circulates in the economy. To calculate this, you divide the gross domestic product, GDP, by the total money supply. For example, imagine an economy where $30,000 worth of goods and services are sold over a year, and the money supply is $10,000. To calculate the velocity of money, you would divide $30,000 by $10,000, which gives you a velocity of 3. Despite a significant increase in the money supply over recent years, the velocity of money has not seen the expected rise. This discrepancy is surprising, especially considering that in the late 1970s and early 1980s, money velocity surged during periods of inflation, even though the Federal Reserve was tightening monetary policy and raising interest rates. Burry has shown various graphs that suggest inflation is cyclical and will worsen if money production continues to rise. Historical data reveals that inflation in the 1980s spiked to as high as 15%, and that inflationary peaks tend to come in waves. The graph highlights that cash flow and currency circulation are not linear, but cyclical, meaning we are likely in the midst of a cycle that will eventually accelerate. In particular, Burry emphasized that if the money supply continues to grow, inflation will likely reach even higher peaks in the coming years, as seen in previous decades. One key aspect of Burry's forecast is that inflation tends to follow a pattern. After an initial surge, it often causes an economic slump, prompting governments to print more money in an effort to stabilize the situation. This, however, only sets the stage for a more severe form of inflation. Burry warns that this cycle, if left unchecked, will worsen over time, leading to an economic disaster that could far exceed the collapse seen in 2008. Burry's concerns also extend to the relationship between inflation and GDP. As inflation rises, Burry argues that the economy will contract, making the upcoming downturn much worse than what we experienced during the 2008 financial crisis. If the economy doesn't recover soon, some sectors, especially lower-income households, will suffer the most. Unfortunately, those responsible for the situation are often not held accountable, unless the Federal Reserve is at fault, which brings us to Burry's next point. In 2022, the White House redefined the term recession following the low unemployment rate of 3% in 2020. This was used to justify economic policies that many experts have since criticized. The problem, as Burry explained, is that unemployment rates are often a lagging indicator. While the unemployment rate may remain low for a time, it is expected to rise sharply as the effects of the recession take hold, especially as the white-collar job market shows signs of collapse. With job cuts likely to increase, Burry believes that the duration of the downturn will be much longer than most expect. Another major issue that Burry highlights is margin leveraging, which is when investors borrow money to purchase more investments. While margin leveraging can work well when markets are rising, it poses significant risks when markets fall. For example, if an investor borrows money to invest and the value of their portfolio drops, they may receive a margin call, a demand from the broker to deposit more money to cover the loss. If the investor fails to do so, the broker can liquidate their holdings, often at a loss. Burry has warned that the current levels of margin leveraging are dangerously high, and if the market continues to decline, it could trigger the largest margin collapse in history. The rapid rise in credit card debt is another troubling sign. Over the past 5 years, credit card bills have surged to an astonishing $4.6 trillion, exacerbating the issue. Many of these debts are being incurred by individuals who may not fully understand the implications of borrowing, which could lead to a financial crisis. This rise in consumer debt, paired with the speculative bubbles in various sectors, raises concerns about a potential collapse. Burry also pointed out the precarious state of alternative investments, such as futures and options. These financial instruments can create a lot of volatility, amplifying the risk in the market. In addition, inflation is distorting consumer credit, making it even more difficult for households to maintain financial stability. All of these factors combined, volatility, margin leverage, consumer credit, and speculative bubbles, create a much riskier environment than many realize. The question on everyone's mind is whether this financial collapse could be worse than the 2008 crisis. With global currency fluctuations and rising interest rates, the situation is becoming increasingly volatile. Banks are acting impulsively, and CEOs are making decisions that could have severe consequences. While Michael Burry has often been criticized for predicting crashes too early, his track record suggests he has been correct in the past. So, is this latest prediction feasible? Time will tell. What do you think about Burry's prediction? Is it something you believe could come to fruition in the current economic climate? Let us know your thoughts in the comments section. If you found this video helpful, don't forget to give it a thumbs up and subscribe to our channel for more updates. Thank you for watching, and we'll see you in the next video.